Hello and welcome to the second episode of Damien's Midweek Markets, the podcast where I talk about what's going on in investment markets and what is likely to happen in the future. Now, I've had some fantastic feedback after the first episode and some really great questions, and the unanimous verdict is that you love the content and you love the length of the show, so that won't change, but do feel free to send in any questions or requests, things you want to see covered. So on that note, let's get on with the show. Where are we with investment markets? You may recall that last week I talked about how the S&P 500, which is the main US stock market, was at a critical juncture. We at this period where it was at 2,600 to 2,650. That resistance zone seemed to be a battleground between the bears and the bulls, and depending on whether we broke up through that, the market was likely to start to head higher, or if it broke back down in a sort of head fake, we could see the market go lower. And what we had is a lot of fighting, and it was just inching and inching up, and then at the back end of last week into this week, we then finally broke above that area, and we're only just above it. We would get towards about 2675, but it was also above the 50-day moving average. And now some people don't really follow moving averages that much. A lot of traders are obsessed with moving averages, and it's kind of like a smoothed version of the actual index itself. So they average over the 50 days or the last 200 days to give this moving average, and they're like support lines, and because traders obsess about them, they tend to have an influence on the market, and we broke above it, and that was a bullish sign because they can be resistance or support lines when you look at your stock app on your phone. Now, with them breaking above, that seemed to set the course for the market to push higher, and indeed you'll go out there, it seems to be everybody's very bullish at the moment about the stock market again, and a lot of the reason was because there was optimism around the US-China trade talks, and it looked like there were going to be a breakthrough. And actually, to be honest, a lot of it is down to convenient tweets from people who are in the US government trying to drive the stock market higher, because believe me, if you look at this stock market, it just got a whole feeling of being rigged. We had the Fed, the US Federal Reserve, which is their central bank, their equivalent of our Bank of England, started to be very dovish, started to take the idea that they were going to keep hiking rates off the table when the stock market crashed through 2,600. And that's where the term the Powell put, as in Jerome Powell, the chair of the Federal Reserve, that he'd put a floor in the market, that was where he was going to try and defend it. He didn't successfully do that, but the market did quickly recover and is now back above that level. But we also see it where as soon as the market starts to fall and it looks like it's going to accelerate, Donald Trump starts tweeting about how successful the US trade talks are going, or he gets somebody to go out there and say the same thing on telly. So they're very conscious, clearly, and the market at the moment has this feeling of being slightly rigged and not actually being free to move how it wants to. So we had that optimism, and there were some signs of optimism about growth as well, that were economic growth globally that was being pushed out there. And there were some fairly good earnings figures that came out of one or two companies in the US. Now, what it meant is that we've now enjoyed a 10% rally since the start of the year in the US stock market, and slightly smaller amounts everywhere else globally. Now, that is one of the best starts almost ever to a new year, which almost has that feel of being slightly unsustainable. Now, if you go on your stock app, I always like to try and bring this stuff to life. If you go on your stock app and you try on, this is if you've got an Apple iPhone. Now, if you try and add in an index and type in GSPC, that is the S&P 500. Go and look when you've loaded it how quickly that stock market has rallied since the start of the new year. And if you flick on and look at the 6-month period, the 6-month window or the 1-year window, you can see the turnaround that's been quite incredible on the stock market. And what we've gone from a very oversold stock market to almost a very overbought one. Now, is the market going to continue higher? It's a very difficult question. The one thing, if you look at those charts, you will notice that when the market sells off, it tends to rebound, but when it does, it will normally have a bit of a fake and then retest that low again, as if to double check that that is the bottom of the market. And then when you get that confirmation, it will rally higher. Now, if you go back to early 2018, you can see it happened, and then the market rallied into the summer before we had it collapse again in the autumn. So there is a suggestion that we could retest the lows that we've seen, or certainly a low, maybe not as low as we saw on Christmas Eve, before the market really does go higher, if it is going to, and to confirm that this downtrend we've had since October is officially broken. So keep an eye, be open to the idea that the market could head lower, not to say it will, but again, this band on the S&P 500 is crucial, between 2,600 and 2,650. If we break below that 2,600 level, then it suggests that we could head lower. And now I'm doing a lot of technical analysis stuff on 80/20 Investor, and I'll probably do so this week and put out a piece showing you all those support levels to watch in more detail. So that's 80/20 Investor, my DIY investment service. But what we had is, after we had some euphoria, this week we had the market suddenly do an about turn and suddenly plummet in the US in particular. So the stock market fell about 1.5% in a single day, and a lot of that was put down to the IMF, which is the International Monetary Fund. They scaled back their forecast for the global economy. They basically said the global economy isn't going to grow as fast as previously thought. There are other indicators out there to suggest that maybe Germany is already in a recession. So these things started to weigh on that same global growth theme that people think we might be heading towards a recession. And so the stock market suddenly reversed. And once it reversed, it started to pick up a little bit of speed. We hit that support line of that 50-day moving average right in the middle of that zone I keep talking about. So keep an eye on that 50-day moving average. Even if you don't put much emphasis on it yourself, it seems to be that other people do. So we are now looking at what's the market going to do. Again, look at that app, look at that index and those levels. Now, one of the most interesting things that we've seen is that the stock market seems to have been detached from fundamentals and reality. And it really is only looking at one indicator it suggests at the moment, and that's the price of oil. And the reason it might be doing that is because oil is obviously in demand when the economy around the world is booming. We need more oil to build things for transportation. So there is a supply and demand metric. So if the economy is slowing globally, then the demand for oil starts to drop, particularly if that fall in demand comes from China, which is where obviously one of the largest consumers of oil. And historically, there isn't necessarily a positive correlation between the stock market and oil, but there has become an increasing one since we've all become panicked about global growth in October. So if you get your stock app out, you can have a look and you can actually track the oil price. And it'd be an interesting exercise just to look each day to see if this positive correlation keeps holding, because at the moment, if you go on your stock app and just type in CL equals F, that's one of the index futures for the oil price, you can almost see when that goes up, the stock market goes up. When that goes down, the stock market goes down. So if you're wanting to get a feel for what's going to happen in the stock market, perhaps, we're not day traders, we're long-term investors, but if seeing what the trend is in oil is at the moment seemingly leading the stock market in the US, which in turn is leading the stock market globally. The other thing to watch is the DAX. Now the German DAX is one of the major stock markets in Europe, but the correlation between the DAX and the S&P 500 in America has historically always been very tight, so they almost move in tandem. But in the last year, that's broken down, and what we saw was the suggestion that perhaps the US stock market would break down and rejoin the DAX. That correlation starts to tighten again, because what was happening, the German stock market, along with most other stock markets globally, was tumbling, but the US stock market managed to stay elevated. And of course, in December, we saw the US stock market catch down with the rest of the stock markets around the world. At the moment, the German DAX is showing weakness again, but the US stock market has been able to rebound more so this year. So keep an eye on the DAX as well, because if that is still showing signs of weakness, then maybe we're going to get another catch down, another pullback on US stocks. Again, the bond market is a good thing to keep an eye on, because the bond market tends to often get it right ahead of equities. Not always, but generally speaking, the bond market, because it's the biggest and most liquid market out there, the institutions pump their money through it, so therefore they place big bets on the bond market. And the bond market and the 10-year Treasury yield that I talked about last week, as an indicator, has shown that people aren't really buying this euphoria just yet that's been shown in stock markets. And you can track that yield on the app on your phone by going in and searching for TNX. that will give you the 10-year yield. So keep an eye on that. If the yield on that index is falling, then that suggests that people are becoming more fearful and they actually think that perhaps the global economy is slowing, and that tends to be negative for US stock markets or stock markets globally. But we've seen that correlation not necessarily work either. So you'd expect if the stock market was rallying hard, that yield would also expand because people are selling out of bonds. But that hasn't happened. And when you get two things that don't seem to be telling you the same story, only one can be right. And in recent months, it's been the bond market. So keep an eye on that. I mean, I'll quickly finish up with one of the questions I was asked after the last podcast, and that was about which sectors would perform well in 2019 and which would do badly. Now, I don't have a crystal ball. I'm not going to pretend that I can predict what will happen. But it's been interesting to see some of the earnings that have come out in America in the last few days. Procter & Gamble is one of them. And if you don't know who Procter & Gamble are, go and look at your shampoo bottle in the shower. They make all sorts of cosmetics and things that consumers buy. And of course, they are a good indicator of the health of the global economy, because if consumers are buying stuff, then they must be feeling pretty happy. And they had some stellar earnings the other day, which actually boosted the US stock market for a bit. So at the moment, you would think that consumer discretionaries, the stuff that consumers don't have to buy, like shampoo, then they wouldn't do so well. But they have been doing okay. So the makeup section of Procter & Gamble did brilliantly. So it's those sorts of sectors to keep an eye on, because people were saying they wouldn't do so well, but then they have been holding up fairly well. So it's hard to predict. In terms of geographies, it's been interesting to see emerging market assets have done well. Again, what's the strength of the dollar? Because that has a big influence on whether emerging market assets do well. When the dollar is weak, then emerging markets assets tend to do well. I'll come back onto why that is in the future, but just as a general rule of thumb, if the dollar rallies and becomes very strong, then emerging market assets tend to underperform. I think that will be it for this week. We've still got the government shutdown in America. That's another story that's ongoing, which we'll come back to in future episodes. Let me know if there's anything you want me to talk about next time. I hope you enjoyed the podcast, and let's just keep an eye on all those levels on the indices that I've mentioned, in particular on US stock markets. Oh, and one final thought, keep an eye on the strength of the pound. It's currently at $1.30, which is a reflection of the fact that the market is pricing in an increasing chance that we either won't exit the European Union or any exit will be delayed.